I'm here with Jorge Gomez, MarketBox Tax and Accounting, and we're just off camera just talking about some scenarios. And I have a client, looking at you, buddy, $100,000 I need for somebody to buy a $500,000 house. This guy's a construction company, obviously owns equipment. He needs to buy a house, $500,000. He's putting 5% down. If somebody needs to make $100,000 to qualify for a home, give me an idea of what they need to pay in federal taxes to qualify. And knowing that, yes, we can use depreciation to play with the numbers there. So what do you think, Jorge?
Well, the first thing that comes to my mind is the legal structure, the tax structure of the business.
Oh.
If it's a Schedule C, if it's a corporation, two different things.
So it's a Schedule C.
Okay, if it's a Schedule C and you have a net income already taken into account depreciation of $100,000, the thing with the Schedule C is that you have to pay Social Security and Medicare on those earnings. It's around 15%. On top of that, you will have to pay federal income tax and state tax. So let's say it is like around $15,000 for Social Security and Medicare and around $20,000 for federal, and I would say around $5,000 for state. So 25, 5, it's almost like
40.
40% of your income just because of Social Security and Medicare. So the secret here is if you want to buy a house for $500,000 is to talk to a tax professional and then structure your business in the most tax efficient way. Because at the end, you're going to have the income and the cash flow, but you're going to really reduce your tax liability if you do it right. But remember, this thing has to be done before because it takes time. You have to apply. Sometimes it's really hard to get retroactively. It's possible, but it takes more work. But if you plan, if you are proactive, you can achieve the best of both worlds.
So you recommend somebody to structure or start a corporation, an S corp ahead of time, and that way they can prepare themselves.
Well, if you have if you run your business as a Schedule C, you can convert it into a corporation, and then we use the S corporation strategy for small businesses. So the income is a pass-through. You need to have a salary. So we need to calculate your reasonable compensation, and then the rest you can take it as a distribution, which is just a profit distribution. You will pay federal income tax, state tax, but no Social Security.
So let's go back to the same question. If they were an S corp already, same exact thing.
Same exact thing. Well, they will have to have a salary, right? And then the rest, let's say they have a salary, and then the $100,000 is just they won't. It will pay only federal income tax, state tax.
So how much would that be now in taxes?
That would be around, taking into consideration the tax bracket, it would be similar, but only like $25,000, I would say. But if we combine it with other strategies, it could be lower.
Okay.
I have experiences, where the client is around 25, and we reduce it like around 10,000, and we do a combination of strategies and reduce it.
So there you go, guys. So depending on what kind of setup you have, structure you have on your company, it may change. But reach out to us if you have questions on that. Don't file your taxes until you talk to a tax professional like Jorge, or before you try to do any movement or file your taxes, make sure you talk to us. All right, guys. See you guys in the next one.